Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as Wealth Advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve, and I got Bill and Matt with me as always, and we've got another great episode lined up here. We have a few listener questions, and we also are going to talk about how some of the younger folks out there are taking some risky bets when it comes to their money. So we'll go into that for a little bit to kick us off. But before we do that, Matt, I know we've talked about this before. You are a race car driver in your spare time.
Sure.
And you've got another big series of races lined up here this summer. And you have gotten a little publicity too, I understand, in terms of the car that you drive. And tell us a little bit about that.
So the organization, the series that I'm racing in is called Grid Life. And they have actually struck a deal this year. They're all of our races are recapped on the Racer Network, which I have YouTube TV, so it's on that. I believe they have an app too. If anyone's looking to find us, you can find us under the Grid Life if you search for that. But they also have a YouTube channel where they live stream all the races, and then all the replays are. The live stream is just saved, so you can always go back and watch it. So one of the fun things that happened was back in May, we were racing in Atlanta, and, they always put out a link to here's the live stream for each day. And it's, prior to the live stream happening, they put a thumbnail, and they used my car as the thumbnail for the day two race live stream. So that was cool, I guess.
Well, show us a picture. Do you have a picture you can pull up on the screen here for those watching on YouTube?
See, of course.
We're teasing our YouTube channel now because you can't see this if you're only listening, right?
That's right. That's right.
Oh, look at that.
There it is. Now that is last year's livery is the technical term. It has been updated. Still same philosophy in terms of black, gold, and red, but slightly different for 2026. But so you can't really tell, but it was pouring rain during this race in 2025. And if you can kind of maybe if you look behind the car, that's a bunch of water. They did a good job though with this image, and hopefully it gets a lot of people watching the live stream or the replay.
So those colors seem to match the Keen Wealth Advisors branding. Am I mistaken there? Or?
They do. There is a Keen Wealth logo on the hood, I guess. It's not really a hood, but on the front of the car. And so definitely got our logo on there. So hey, we'll take it.
We'll take it,
Very
Matt.
nice.
How did you come up with the 188? So you're piloting the 188 machine. And how did you come up with the number? Just curious.
Yeah, I wanted to be 88, and it was just easy. I for some reason I picked that in different different series, but someone had already selected that, so you can't have leading zero. So I had to put a 1. So 188. That's the number.
You're making a name for the 188 machine on the tour. So
That's right. So
yeah, I get on there and watch. I get on there and watch just to make sure everything's going well for the president of our firm there over the weekend, Steve, and keeping the car right side up and so forth. So far, so good on that.
Right.
I've ridden with Matt before. So
I thought I saw some big roll bars on there. So it looks like your cockpit where you're sitting in that car looks like it's pretty heavily protected.
It is safe. That is true. Yep. There's a lot of safety equipment involved. It's good.
Very
it's
cool.
fun. Yeah.
Very nice.
See how the season shakes out.
Yeah. Well, we expect to see you atop the leaderboard.
Just going
No
out there and
pressure.
having fun. We'll put it
There
that
you
way.
go.
Well,
There's
he
some
That's
got
right.
he got
very
driver.
good drivers in this series.
Well, he got driver of the year in the Midwest here a few years ago. I bragged on him multiple times on the program
Yeah.
here, and then he went. He's gone national now. So when he's racing national, I guess you got the best in the country getting together, and so yeah, pretty cool. I would
Yeah,
expect no less from Mr. Wilson, though.
that's right.
A man of many talents.
Uh-huh.
That's right.
All right. Well, let's jump into the key piece of our episode here today. And I think there was a Northwestern Mutual study that came out here recently that I think prompted this idea to talk about how a lot of people are taking speculative bets. So, Matt, why don't you walk us through what that's showing and what it might mean for us?
Yeah, so I saw this article, basically back in March, and it was talking about this Northwestern Mutual report that came out, and it said 39% of Americans are turning to, riskier bets, and they're investing in things that they consider, I would, again, high risk, like crypto, options, prediction markets,
Ugh,
sports betting, meme
ugh,
stocks,
ugh.
there's a lot in there. Um, and the reason they're doing so, it's not just because they're looking for a get rich quick kind of solution. It's because they feel they're behind. So 73% of the people that they, surveyed that said now they're taking that, um, the more high risk investment is because they feel that they're financially behind. And then if you look at just Gen Z, it's 80%. So it's not, again, it's not greed, it's anxiety.
Anxiety that they're behind plan, I guess, right? Or they
That's
don't
right.
know though. I
But
I would contend they don't know that they're
Yeah.
behind plan
How
'cause
do they
probably
know
don't
what the
have a
plan
plan.
is?
That's
well,
correct. Yeah.
that and when you're younger, it it takes a while to things to compound. It can look like, hey, my net worth isn't changing much.
At first, at the beginning,
Yeah,
right?
it takes time.
That's right.
I
That's
mean, the
right.
rate of returns could be phenomenal, but if you go from $100 to $200, that's, you've doubled your money, but that doesn't feel like a great, hey, that did really well. So, but over time, that money just keeps compounding, and if you keep adding to it, it adds up. So that's where I think people are they feel behind, but they don't really know the math behind how all this stuff works. I mean, we mentioned it's been a long time. I remember
Mm,
us talking about this, but it was like when Buffett got his first $1 billion. I mean, I think it was close to almost 60.
right. That's right.
And then, from there, it's just not that $1 billion is a small amount of money, but, to turn into whatever, is it 100 billion, 75? I don't even know the number that he
Right.
has, but it's a lot, several, it's a lot of billions now. And it's all because of compounding.
Right. And remember we talked too on the program a time or two about when you first start investing, your account is growing because of what you're adding to it.
That's right.
The majority of the growth each year is just what you're adding because you don't have a whole lot to start compounding of yet.
Yep.
And then you get to a point where the actual growth of the investment is coming from growth, and what you're adding is now a smaller subset of the growth of the account each year, where the account's now got a balance of say 100,000 or so, and if it goes up 10% with like a stock market year, maybe it grew more than what you put in, but you have both things happening. You're still putting money in your company,
True.
hopefully as well, and it's growing. Not every year, but remember when things go down for that 1 out of 4 years when things are down, you're buying more shares cheaper.
Yeah.
And then you get to a point where, okay, it starts to take hold. You realize this is working. And then you get to a point where a number of years down the road, where a lot of people say, and they take note of this, they say, my goodness, this account has gotten to a point now of scale and size that it's actually going up more than their actual entire salary in a given year. They might let's say they make 100,000 a year, but they had a portfolio built up of
Yeah.
$1.5 million or something along these lines or more. And they're like, oh my gosh, the account went up more than my entire salary. for the year, but it
Yeah.
takes time. It takes time. And
Of course, on the flip side of that, people see it go down and they're like, well, wait a minute, I'm working for free. It went down by more than
my
what I made.
salary. No,
I
in
mean,
those
they do
1 in
say
4
that.
years.
It's like, well,
yes.
yes, it went down temporarily, but still,
Yes.
yeah.
Temporary declines. We always like to say when I never like it when we say, or if someone says we lost money. So no, the asset temporarily declined. It does make a difference. The semantics and I think it's the understanding behind the semantics that really matter.
That's right. That's
yeah.
right.
And we're also fond of saying here in the financial profession that it's time in the market, not timing the market.
Oh, yeah.
So, yeah, it's all about having patience.
Right. Yeah.
So I had some numbers for fun as I knew we were coming up with this today. And I know this sounds like a long time frame, but I think we all agree that time passes very quickly. In some cases, it doesn't when you're in school watching the clock for the class to be over. But in most cases, time passes pretty quickly. We look back. I know the time has passed quickly for me at age 57 here. But if you started in January of 1996, as an example, and you were just able to put $1,000 a month into the S&P 500, which is just a broad index here, largest, call it 500 companies in the U.S., and you did that for 30 years, it would have compounded out to about $2.3 million. If you went back another 10 years and had that be 40 years and just left it alone, it would have compounded to, I say leave it alone, continue the $1,000 a month, right? Now, realistically, as you make more money, you put more than the $1,000 a month in. Maybe up front, you put a little less, but with the company match, folks can get to that $1,000 a month relatively quickly in their career. At 40 years, it would have compounded to $7.2 million. Isn't that crazy? I mean, it seems like, yes, it's a slow start, but now I went back another 10 years to 50 years, and a lot of people think, oh, that's way long. But you know what? I've funded like my kids' Roths and helped them get Roths started, and even 529s for the grandbabies right when they're born. So maybe 50 years isn't that crazy to think about, but the $1,000 a month ends up being over 28 million in this time frame we looked at. So, and you might recall over that time frame, the markets, including 01 and 02 and 08 and 09, those really tougher few years that we saw, the market went down by 50% temporarily a couple times in that time period as well. So, things to share, to be aware of and have knowledge of when we're training people on the innate core wisdom to wealth building over time.
Yeah. Yeah. And it's not about which one is, paying the most. That's another kind of phrasing that sometimes people use, or which one has the highest rate of return, just looking back, because that's common. You look at whatever your choices are inside your 401k, for example, and you look if it's got a 10-year number and the one that has the highest one is the one you select. Well, that doesn't say anything to how that return was achieved, for one, because just because it has a high rate of return doesn't mean you could actually stick with it if it's very volatile. Like, for example, crypto, if you go back 10 years, is probably one of the highest returning asset classes if you include it as an asset class. But I don't think there's many people that could have withheld all the volatility over the last 10 years. There's some out there, but there's probably not many because it is very volatile.
You're talking about now you're talking about behavioral, finance,
right.
the psychology around this.
So you're doing everything, but you just can't stick to the investment that you chose.
That's right. That's right. So you talked about looking back 10 years. I mean, sometimes folks come in and they look back at their 401k or something. They look back at what's done best over the last 1 year even, and then try to think. It's like, I always like to use that analogy or metaphor of driving forward in a car, looking in the rearview mirror for your forward guidance. That works maybe for a little while until it doesn't. Right. So, yeah.
Yeah,
always good to come back to the core wisdom here, Steve.
Right. Yeah. I also like the old metaphor or analogy, however you want to frame it, of how frequently people are looking at their accounts, or in this case, how frequently they might be changing their accounts. And it would be like, what if you were a gardener? Would you want to pull up your plants every week and look at the roots and see if the roots are doing okay?
Right.
It's like, no, you don't want to do that. Same thing with your investment portfolio. You don't want to be changing it every other day.
That's right.
You don't necessarily want to be looking at it every day. because the behavior is gonna take over. You're gonna make some decisions that you might regret down the road. So just like you let plants, water them, nourish them, fertilize them, let the sun do its magic, and over time, it's gonna blossom.
That's right.
That's right.
All right.
I can contend after 35 years or in my 35th year of doing this, got a lot of, and myself being an investor for, all that time as well. What we're speaking is not theory. I mean, it actually,
Right.
it works in practice. It really does.
Yep. All right, good. Well, let's go on to a listener question here. And this question, they're asking, is the US dollar dying? Should I move into gold or foreign currencies? And so this is a theme that we've heard in recent years, that the dollar is going to be overtaken by some other currency, and the US has so much debt that we're dealing with, and no one's going to want to own the dollar and that sort of thing. So let's separate the fact from the fiction here.
Sure. So there's two different concepts that are involved in this question. So it's the dollar is about to lose its reserve currency status. Like, that's one of the things that the question's asking. Because the other thing they're asking about is that it's collapsing. So those are the two different pieces to it. So then when we talk about like the reserve currency, so what is that? Well, that just is what is trade. What currency is trade happening in? And when you look at it, and this is data that's publicly available, the IMF, I think, publishes this every single day. And you look at the global, like the central banks across the world, they have about 11.5 trillion in reserves. So it's just all the different currencies that all the central banks own. When you break that down into what currency is as a percentage, 57.8% of that is US dollars. The euro is 19.8%, the yen 5.8%, the pound 4.7%, and the yuan 2.2%. So, you look at the dollar and it's 3-1 over the next largest currency, which is the euro. And so what would cause that to change? Because people have been afraid of this, I think, for a long time, but also, maybe more so recently, just because there has been, I think, more articles and more commentary from other countries, maybe saying, well, we might like something different. At certain periods of time last year, there was conversations or articles that I saw around China and Brazil and, Russia and other countries wanting to do something different and not be, subject to the US dollar as much in terms of global trade. But what you need to do is you need to get all the participants to all agree to say, okay, we're not going to use the dollar, or, we're going to come up with a different system, and everyone has to trust everybody. So
yeah, that's tough.
If China says, okay, well, we want everyone to use the yuan, it's like, well, if no one trusts China, they're not going to use the yuan. It's just, it's a trust game, so to speak. And two, it's also like, you look at, okay, well, what happens when things are actually, when things are going, I want to say going bad, but let's just say there's more tension in, in the world, or there's recently with the situation in Iran. Well, that caused the dollar to increase in value because there was more money from across the world coming in and buying dollars, because they felt that was the safest place to be with their excess currency. Like, they didn't want to own a currency that could be potentially at risk of not paying or going bankrupt. I mean, not that that's like a huge risk, but it can happen. You hear about these countries that have out crazy inflation, and their currency just continues to collapse.
Sure.
And it's like, that's not, it's not going to happen in the US, even though our inflation's, higher than an average. It's not going up by 200% a year or 200% annualized like it has in, in some countries that just have no monetary policy and no central bank controls or anything like that. So that's a little bit on the global reserve currency side. And then the other side, so this is where like a lot of these things probably online on YouTube and others, that they're just conflating all these kind of issues, making it sound like some one big interconnected problem, and they're two different things. So the other is like where it's saying the dollar is collapsing. Well, I mean, when you think about it, and we've talked about this constantly, is like, well, why do we invest money? Like, why, like we just talked about the rate of return that we get from owning stocks over 30, 40, 50 years. Well, why do we do that?
We want to have more later, net of
We
the
want to outpace
inflation rate.
inflation.
Yeah, net of inflation. Yeah, that's exactly right.
Because
That's
we
right.
know, well, if we just held it in dollars, inflation means we can buy less in the future. Well, that's the same, like, but what they did, like, you mentioned it earlier, Bill, about the phrasing. Well, now instead of that, it's now phrased as the dollar is collapsing. So you're like, oh, whoa, what's going on? Like,
Right.
no, it's inflation.
Inflation. That's correct. Yeah.
Yeah, that's all it is. It's just inflation. So, like everyone, even people, they're just like, well, I don't want to keep a bunch of cash. I should at least put it in something that's earning interest, right? Like, it's just that concept.
Yes. Yes.
It's not, but when it gets positioned as the dollar is collapsing, it's, and 97% of the value of the dollar from 100 years ago is, and the reason inflation's good, because the other angle to all this, because, it gets positioned as it's such a negative thing. Well, whoever had the dollars 100 years ago would still have all the money.
Yes.
Right? I mean, if they weren't required to do something with it and
Transact.
just sit on it, they just had to. No, there's a finite amount of money in the world, and we got it, and too bad. You all, like, that whole concept doesn't make sense if you think about it. But people want to promote it like Bitcoin solves that because there's a finite amount of it, and it's like, so then what happens to the people who don't have any? You think they're just out of luck? That's just too bad.
Right. And then extrapolate that to something we all have experienced, and that's all of our standards of living, and not just in the U.S., which have more resources than many countries out there, but even if you look at poverty across the world, the poverty rates have come way down. Standards of living across the world. I mean, in many countries, emerging markets, they didn't even have phone lines. They went straight to mobile phones, and we could talk about a lot of different things in the efficiencies, and that's how this all extrapolates into real life. How it affects everyone, literally, on the planet.
Yeah, because you're forced. I mean, if dollars weren't deflating, you would never be forced to invest, and that's what an investment does. It creates these things. So it's
and don't you think, Matt, why we came off the gold standard? Again, not that we want to veer off into now talking about why we came off the gold standard so many years ago, but the ability for the Federal Reserve to be able to, I know they get a lot of bad raps, but to be able to expand the money supply and do things that allow for growth and investment, and again, all ending up in our standard of living.
Yeah, because if we're subject to the amount of gold, which again is like, well, why did they pick gold? Why didn't they pick something else? They just picked gold. If we're subject to the amount of gold to our growth rate, it's like, well, that
be very limiting.
It's just an arbitrary made up thing. So, they abandoned that, and it's just based on, now it's more based on the ability to tax and actually have a secure, financial system that everyone seems to agree is the best one that exists. I mean, when the euro seems to always have its issues every so many years, where one of the countries is going to go bankrupt and take everyone down with it, and then you've got all the other issues with some of the developing countries where the governments are just still not necessarily as trustworthy as other governments are. So you got to take that all into consideration and say, okay, well, if we had to pick one, which one are we going to pick? Right now, it's the dollar. Doesn't mean it's going to stay that way 100 years from now, but that's where it's at today.
That's right.
I was just looking at a chart here. So there's what's called the dollar index, and then dollars are also traded on the futures market.
Yeah.
So this dollar index is basically looking at the U.S. dollar's value compared to other currencies like the euro and the yen and some of the other different currencies there. So you can see a chart over time, like how has the dollar's value changed over time relative to these other currencies. And so 5 years ago, the value of the dollar relative to these other currencies was lower than it is today.
Yeah.
And so we're at a higher value of the dollar than we were 5 years ago. Now, when people say, oh, the dollar's collapsing, they cherry pick time periods.
Yeah.
And so if you go back to January of 2025 to today, roughly today, it's down about 10% relative to a peak in 2025. But just go back 5 years ago, and it's actually up since then in single digit percentage points. So it all depends on what your time frame is, what you're looking at. But yeah, clearly at this point, there's no collapse in the dollar. Not to say it's not going to happen in the future, but there's definitely no collapse happening in the dollar at this point.
It's all relative to those other currencies. And if we're importing versus exporting, I mean, there's pros and cons to strong dollar, weak dollar. There's not,
right,
but it's not going to zero against those other currencies. It's all trading around a range.
Yeah,
that's right.
Yeah.
And then the antidote, if we look at it, like what do you do about all this? A lot of talk about it, but what do you do about it? Well, in my example of the outset of the program, we talked about investing in the broader stocks of the U.S. If you go back to 1950, the S&P has compounded at somewhere north of 11% a year, and then the dividends. And we talk about this too. The dividends on the S&P. If you can two ways to make money. One, you buy a stock, it goes up in value. That's one way. The other way is you buy stocks that pay dividends, and they typically pay out about every quarter some percent of the profit. The dividends on the S&P have actually grown at 5.5% over that same time frame. So really, the most effective and effortless inflation hedge is owning a broad basket, a diversified pool of equity securities. Yes, one in 4 years, they go backwards a little bit, typically on average, but long-term, that's been the antidote, right? I mean, that's the action item, I guess. Or the non-action item would be trying to go in and out and time all this. And gosh forbid somebody tries to trade currencies even. I mean, you didn't even mention that on what the young people are doing in the first article, Matt. Oh, luckily they're not trying to trade currencies too, along with meme stocks and betting apps.
Yeah. Well, with that said, let's go to the second question here. And I'm anxious to hear how you guys are going to answer this one. They're saying the Treasury just declared the U.S. is insolvent. Should I be repositioning my retirement? So
now, I wonder who actually said that the Treasury said.
Well, this was a link to an article. It wasn't that.
Okay.
The article.
Okay.
The article writers use that as the headline.
Oh, the headline. They got our attention.
Self-report. Oh, we're bankrupt.
And I had somebody that's been with me, us as a client for 26 years, send this over. So I don't want to downplay this either. I want to take it seriously, right?
Well, because they sent it. And so we looked at it, and it's like, when I see the headline, okay, the first question is, what are they selling? Right? Because why else? What are they positioning here? I mean, that's like that's all this. A lot of that. Even the last question about if you're reading an article about something collapsing, it's like, well, they're trying to sell you something, and they're just positioning it as the solver, the solution. And this article was unique. They weren't selling anything, which was surprising. It was actually written by they're professors, I believe, that wrote it, and they're more so just calling attention to the fact that they just ultimately the takeaway was they just believe the U.S. is spending way more than it should, and that's not sustainable long term. That's their kind of thesis,
and we can agree on that probably, right?
Well, yeah. It's like it may not matter ever, as long as we keep growing and GDP keeps growing and the tax base keeps growing, as long as that continues to happen. When we put everything in dollar terms and not percentage terms, you can't compare it to history, because the dollars will always be more. We'll always have more debt, because the debt's never getting paid off. It's not going to zero.
Right. The annual deficit might move around, but the actual debt, the long-term
dollars that are owed will go up as everything else increases too. Just like, if your income goes up over time, everything increases. You just can't say, well, dollar for dollar, it's not the same. You got to compare percentages and things like that. And it is high. I mean, even if you do compare percentages,
that's right,
it is high. But again, it's like one of those things. It's known to everyone. It's the unknown things that the market is scared about. And we don't know. It's the unknown unknowns. We don't know what those are. When everyone's
Right.
talking about it, it's like, that's not necessarily the cause of the issue. There's something else. And no one knows when or if that'll ever have an issue or be a problem. Now, here's where the article, though, is misleading. And this is really why they're saying this, is they're just saying the Treasury, they put out their financial statements every year. And the Treasury said they had 48 trillion in liabilities and 6 trillion in assets. So that's,
That's concerning.
That's
Yeah.
what they're using as the Treasury declared themselves insolvent. And okay, I mean, that's just a division of the government reporting on what's on their, books, so to speak, within the broader government. So what it doesn't say is, what is the value of all the assets that the US government owns? Like, no one ever seems to really think about that.
Like property. Let's just say, even if you just called out land, national parks, things like this, that's not on the balance sheet.
No. And I mean, it wouldn't be on the treasuries for one, but two, it's really not accounted for anywhere.
Mm-hmm.
So, I've looked this up in the past because I've talked about it in some of the webinars over the years, but there are roughly 640 million acres of federal land. I mean, think about that. That's 28% of all the land inside the US.
Yes.
I mean, if you had to put a value on that, the estimate that I read is roughly $150 trillion. And then if you added on top of that, the mineral, oil, gas, and timber rights, that's another $200 trillion. So there's $350 trillion that always just seems to no one ever puts any value on that. Again, it's not an argument for the government to keep spending. So that's
right.
We're not trying to advocate for that, but it's just the concept of everyone wants to compare. And these are, some of these liabilities are 75-year liabilities. Like they're carrying Social Security and Medicare as the total that we owe the future, not just what it is today.
Right. That's right.
So we're going to say, well, current assets, which are what's basically just on deposit at the Treasury, but we're going to take long-term liabilities and not look at long-term assets either. It doesn't make sense. Like it wouldn't, this is not utilizing generally accepted accounting principles, GAAP. These are not, these would not pass an audit. They'd say, well, wait a minute, you can't match these things up. It doesn't work that way. So what they're advocating for, again, is I think a more fiscally responsible government, but they did a good job because it's getting people's attention, at least to talk about it, but it's little misstated, I think, on some of this.
I appreciate the clarification there. And we've been talking about debt issues. I mean, I remember back in the Reagan days, and I think I've said this on the podcast before, where I remember back then we were talking about how horrible the deficit was and it was going to lead to ruin of the country. And back then, I mean, the numbers were just a tiny fraction of the debt that we're experiencing today. Now, of course, the economy has grown substantially over that time, but the rate of the growth of the debt is higher than what the economy has grown. And that's why the percentage of our debt as a percentage of the economic output of the economy has didn't that just recently cross 100%?
It has,
yeah, right around that, which I think back in the Reagan days, it was probably, and I'm just guessing off the top of my head here, but I'm thinking it was probably closer to maybe 30 or 40%.
Yeah, it was
where our debt was
lower. Yeah.
Yeah, substantially lower than it is today. So yeah, it's definitely higher. And everyone seems to think it's going to be a problem. And it's like that old saying, gradually, then suddenly. And so we'll see.
Yeah. I mean, it's not a problem until it is. And if it ever is,
right.
And again, it's kind of like, well, what would that entail? Who knows? If it's, really the way I would think about it is, well, less people would have a desire to own US dollars and US treasuries if that was the case. But right now that hasn't, that's not being materialized or it's not seen in any of the actions by investors, by other countries. No one's abandoning the dollar. They're not, dumping,
That's right.
you hear that, oh, they're dumping their US treasuries. And it's like, well, a lot of that, it's like, no, that was just planned roll off or whatever. It's just, this stuff's just financial media nonsense.
So the article, I think, did have a couple of good points, and it ended, if I recall, by proposing a couple pieces of legislation with respect to just being fiscally responsible, and modeled in some spending cuts and things, which is reasonable, right? Those are reasonable things for engaged citizens to support. But what they are not is a reason to go out and make a panic decision and sell all your investments, especially your equity securities. It is not a reason to do that, or to make some snap emotional judgment there and upend your portfolio that was hopefully well drafted and updated by a fiduciary professional to support your goals and your family's goals in life.
Right.
So two things there. Yes, policy, maybe less spending, of course, fiscally responsible engagement, but not a reason to blow up your financial plan. Change a bunch of things around.
Yeah. Well, let's tackle one more question here. And there's been a lot of talk here recently about allowing 401k plans to invest in private equity or private credit. And definitely some conversation around that. So what are your thoughts? Is that a good idea, bad idea? Where does it stand today?
Yeah. So I think when this was first proposed, and again, it's coming back up again, because I think it's going through, through the legislative process. It was discussed about a year ago. And, for one, let's take it and figure out, okay, well, what's behind all of this? Well, who's advocating for it? Are consumers like, hey, wait a minute. We want all these structured things with all these hidden fees. We want access to that. Why don't we have access to that? Well, of course, they're not saying that. It's being driven by the people who create the products. They're the ones advocating for it, who are lobbying Congress to say, you should allow because those consumers are missing out. They're missing out on the ability to pay us higher fees than they should, because that's really what all it is. All it is repackaged as a bunch of stuff that you can get to already inside your 401k plan. Maybe not exactly the same way, I'll clarify that, but you can achieve all of your goals in a much more efficient way without having to invest in some product that you have no idea how it works, that could potentially have lockups and, significantly higher internal expenses than what you need. And really what they might tout is, well, this is what the ultra high net worth people do, and this is what so-and-so. And it's like, yeah, sure. Okay. So then if it's so good, then why are they offering it to me? Well, because they want more buyers of their products again. And it's like, the other angle is, well, it's not as volatile, doesn't fluctuate as much. Well, part of it is because it's not liquid. So it doesn't, like your house. How often do you get a price on your house?
Right. You don't know what the price is.
Yeah.
Really.
The government, if you have property taxes where you live, real estate taxes, they'll send you, here's what we think your home's worth. And that's,
I got one of those letters, Matt. I think you probably did too, since we live in the same neighborhood. Everybody's up in arms.
Yeah, they've been raising them, and everyone wants to fight them, but it's usually way less than what the market value is generally.
Still,
but not always. So you get that, but you don't get offers every day. And if you did, you'd probably get really low offers on your house. If you wanted an offer like this instant, I want to close today, it's probably not going to be a very good offer. Just the way real estate works.
We call that mark to market. So mark to market
means
market
is every day.
All day, what prices are. Yeah.
Which is good. It's liquid. That's the idea behind it. It's not a negative. It's a feature, not a bug. People think that's a problem that it's volatile. It's like, no, that's how it works. So again, it's like, I saw there was an article written by Morningstar, and the author was Christine Benz, and she titled it "A Solution in Search of a Problem," which is exactly what this is. There's not a problem within the 401k plans that need this as a solution. And my take is, I think it's going to be most plan fiduciary. So, I mean, that's like when you have a 401k plan that you're responsible for as the employer, you have a fiduciary obligation to make sure that the plan is meeting certain criteria. It's all part of the rules from the Department of Labor, and that it's appropriate investments, and that the cost is competitive with other plans its size, because they do take into consideration that a small company startup plan is going to be different than a huge business that's got 100,000 employees. Like, there's just different cost structures, but it's got to be competitive for for the size of the plan. And that, because if you breach any of those things, the participants can sue you as the plan fiduciary, which is, the company that's sponsoring the plan.
Mm-hmm.
So if they now have all these investments in there that they don't necessarily understand, but they think they need to have in there, and all of a sudden the participants have a bad experience, those plan fiduciaries will get sued. And, most of them, I think, realize that. And so they're going to take their time before they just allow this stuff to show up inside 401k plans.
That's right. Go ahead, Steve.
Well, I was just going to say, one of the arguments in favor of private equity, and I'm not saying necessarily they should be in 401k plans, but what people will say is, if you think about how the financial markets, the stock market is structured today, there are a lot fewer publicly traded companies today than there were 10, 15, 20 years ago. And so what's happening is a lot of the private companies are staying private longer before they go public. And just as an example, when Apple went public in 1980, its market cap when it went public was, I think, less than $2 billion.
Yeah.
Now look at SpaceX, which has not gone public as of the date we're having our conversation here today, but it appears that its valuation is over $1 trillion. They're talking about going public. And so the question then becomes, well, Apple went public at about $2 billion. SpaceX isn't going to go public until they're like over $1 trillion.
Sure.
Well, who is benefiting from that $1 trillion in increase in valuation? Well, it's all the private investors. It's all the people that are investing in it before it goes public. And so and I think it's interesting to think about that. It's like, where's the right balance in there between public markets, private markets? We know in the private markets, there's a lot less information available. And so you're having to rely on other people more so to judge what's worth and what it's worth and what it's not worth. A lot of higher fees in the private markets relative to the public markets. So there's definitely some pros and cons there.
Way higher. Like a lot of cases, like double and maybe even participating fees, where there's a baseline fee, and then anything over a certain amount of return, they maybe get 20%. Think about that, 20% of a return over a hurdle, or 10% or 13%, whether it's private credit or private equity. And again, we're not trying to absolutely poo-poo this, because to your point, Steve, there are things that are private that folks have invested in for many years, but it's what we're looking at is the capacity to
inside a 401k plan. Yeah.
Right.
Inside of where you said earlier, Matt, there's not a problem with the 401k. And I agree. There are problems though with the participants in the 401k.
It's not the structure.
So it's what are the issues though that can be changed? And we'll talk about that before we close. But we look at these private investments. I was meeting with the private credit firm here recently, and I asked about the valuations. We talked about that mark to market. And this is an established private credit firm that goes out and buys bonds, packages them together from companies. I say bonds, they're issuing debt to private companies and then repackaging the other side of that to investors. I said, well, how do you come up with the value of what those things are worth? And they said, well, we just make it up. Now, they didn't just say they made it up like out of thin air. They have formulae and things, but it's not on a market
determining.
So that very same security, or that very same loan, I would say, that's being repackaged to the consumer could be carried on one private credit firm's balance sheet as a certain value, but on another firm's at a different value. They decide what they're valued at. And yes, and they're acting in good faith. They don't want to lose money for investors or cause problems. But
sounds like 08 all over again with the subprime loans. And all of a sudden they were worth normal par, and then all of a sudden they're worth zero. Oh, okay.
How did that happen?
Gradually, then suddenly.
Yeah.
Things that are opaque, right? So, and we saw this. They have limitations on how much you can get back in any given typically year or quarter. And so if redemptions requests start coming in, you might say, hey, I've got this money in this private credit.
Out.
And there's like, well, sorry, but we're not going to be able to give you what you're asking for at all, or some smaller portion of that.
Yeah.
And so really thinking about liquidity needs. And then when it comes to the private equity side, how do you know how to diversify? I mean, every major firm you could think of that any of you have heard of that are financially astute, paying attention to the major investment bankers and banking firms in the country, call us regularly to try to get in front of us on their new private equity packages, the different things, whether it's infrastructure, real estate, you name it, oil, gas, energy. And how are they packaging these things? How diversified are they? How liquid are they? And the fees, which get me every time. So, that typical 2% of assets and then 20% of the growth over a certain hurdle. You got to overcome all that. And then you dial back to, what if I just did a diversified portfolio of fixed income and equity investments? We've already shared some of the longer term returns here. We already see in our financial plan that we only need to get I'm not saying we're only shooting for 5 or 6%. In some cases, people don't even need that for their plan to work. But why would we go outside and start tying money up in illiquid investments that are way higher fees if the client just simply doesn't need it for the illusion that it's less volatile? Because it's not. Okay, so again, not to poo-poo it. People have done it. There's a market for it. But broadening out to all these participants in 401ks who I would say, I don't have numbers, but if I had to assess over 35 years of doing this, 95% of the people in 401ks would not understand it, maybe even higher. We're not going to be able to throw our hat in yet on that, if ever.
Excellent.
Yeah. And I did say, Steve, I did say we would talk about the problems, not with the 401k, but with the behavior of the participants. Mm-hmm. Remember we saying that? So I think maybe it's good to say that, but I think the key would be folks that are under contributing to their retirement plans. They're simply under contributing.
Yeah, let's solve those problems first.
They could be more educated and putting more of their resources in, understanding they're getting in most cases a tax deduction, or maybe using some combination of pre-tax and Roth.
Not even getting the match.
Not even getting the match. That's right. Imagine that. Talk about free money on the match on some of these, and then not having the right allocation. Yeah. Someone thinking they want to be safer, so they have it all in the fixed accounts, like in the money market account.
Yeah.
I mean, we've talked about firms where we've seen clients come in at the same company and same amount of income over the years, same amount of contributions. One gentleman had 200,000, the other one had 2.4 million because he was allocated right, and the first person had it all in the money market fund. Like, those are massive move the needle decisions that folks, I think, need to understand and be optimizing for before going out and thinking about these exotic solutions, I guess, or ideas.
Liquid. Yeah.
Time in the market, understanding long-term investments, understanding the compound effect of tax deferral, all that. Yeah.
Yeah.
Again,
I mean,
wisdom.
it gets back to the basics, and we talk about the basics all the time. And the reality is the basics work. And
blocking and tackling.
Yeah, exactly. Stay in for the long run, be diversified, and you're going to let time work for you instead of against you.
That's right. Yeah.
All right. Well, good. Well, we will wrap it up there. Appreciate you guys as always. And for each of you listening, if you have not already subscribed to the podcast or to the YouTube channel, please make sure that you do that. Of course, always tell all your friends and colleagues about what we're doing here. We'd like to continue to expand the audience for this and make sure that we're reaching and impacting more people with this. And if you have any questions or comments about what we're doing here, or want to get your question answered on the show, please make sure that you reach out to us at keenwealthadvisors.com, and we'd be happy to answer your question. So, all right, guys, thanks again. And we'll catch you on the next episode of Keen on Retirement.
All right. Thanks, everybody.
Mm-hmm. The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.